Corporate Finance Excel Practice Problem. In this presentation, we're going to work a practice problem in Excel related to leverage analysis. This is going to be the second problem of its kind. It's going to be the first part of the second problem of its kind, where we're going to have different scenarios and be focusing in on what's going to be the result of the leverage with relation to those scenarios. Get ready. It's time to take your chance with corporate finance. Here we are in Excel. We have our information on the left-hand side. We're going to populate that into the blue area into our worksheet on the right-hand side. We're going to have a couple different scenarios. We're going to have our starting point and then two different scenarios from that point. Those scenarios being debt-focused and one being more equity-focused. So starting point, we're going to have the assets are going to be the $30,000 in assets. Then we have the financing of those assets split 50-50 between liabilities and equity. We're going to say the debt is going to be the $15,000. Equity is going to be the $15,000 as well. On the debt side, we're going to have to finance it with interest at the 10%. On the common stock side, the par value is going to be $10. Then we have the refinancing options. We got a debt focus and an equity focus option. We're going to start off with the return on assets being the 10%, tax rate being the 35%. If we look at the debt-focused option, we're going to say what happens if we take the take out long-term bonds, meaning we're going to issue bonds, issuing basically debt. So we're going to have liabilities going up, and the amount is going to be for $8,000, and then the tax rate is the rate of the bonds is going to be 13% on the interest. And then we're going to use that money that we get in order to purchase the stock. We're going to purchase the stock back. We're going to take that $8,000 and purchase 800 shares of stock because the price is the $10 to purchase back the stock. And then on the equity side of the equity side of things, we're going to say, well, what would happen if instead we issued the 800 shares at $10 price and take that $8,000 we would get and then pay down the debt with that? That's going to be our second option. We will start off with these three scenarios up top, and then we'll go on probably in a future presentation to think about some adjustments we would have to the data on the left-hand side. So we're going to go back up top. We're going to basically look at our income statement. Bottom line of the income statement is going to be the same for our three options, the current options, the debt and equity refinancing options. So I'm going to say, all right, well, what if we start off with the earnings before interest and taxes, basically net income, before we consider the interest and the taxes? Currently, we're saying we're going to have a 10% return on assets, and the assets are $30,000. So if we pick up that $30,000 times the 10% return, we're talking $3,000 for each option. Now, you could add zeros to these if you would like and say, this is in millions or something like that. We're going to say the $3,000. And we're going to say the debt is going to be the same and the equity plan is going to be the same. That's going to be our starting point, which will be the same. Then we'll get to where the differences are going to be happening, starting with the interest and then the tax, and that'll have an impact on the taxes as well. So then we're going to have the interest. Now, we started off with the $15,000 debt at the 10% interest. So if I then say this is going to be equal to the $15,000 times the 10%, that's going to give us the $1,500. That'll then give us the earnings before just taxes now. Taxes. And this will be equal to the $3,000 minus the interest. And let's put an underline here. Home tab, font group, and underline so that we have the earnings before taxes. Now let's calculate the taxes, which I believe the rate was given here at the 35%. So if I take that earnings before taxes, the $1,500 times the 35%, picking up the 35%, we've got the $525. Let's put an underline here. Home tab, font group, and underline. Then we'll say the earnings after taxes then. And let's see if I can copy and paste that one so I don't misspell anything. And then this is going to be the $1,500 minus the taxes, the $525. There we have the $975. Now, if those are our earnings, we can break that out to the common shareholders to figure out how much we have for the earnings per share. Now, the common shareholders doesn't mean there's this many shareholders. This means there's this many shares that are outstanding. One person can have multiple shares, but we're thinking about how many units we're allocating this amount over in terms of standardized units. Now, there was $15,000 in equity. We're going to divide that by 10 because that's going to be the par value. So that'll give us the number of shares. The 15,000 over 10, number of shares, 1,500. Then we're going to have the earnings per share, the EPS, earnings per share. And that's going to be equal to the 975 earnings after taxes divided by the number of shares. Let's add some decimals. Home tab, number group, adding decimals. We could keep going. I'm going to stop at 2. So starting point, 0.65 earning per share. What if we do this refinance with the debt focus? What's going to happen to the earnings after taxes and the earnings per share? If we think about the debt plan down here, we're going to be getting $8,000, and it's going to have a fairly high interest rate, the 13%, and use that to buy back some of the stocks. So then we'll have less stocks that will be outstanding. So let's think about what the interest will be on that first. I'm going to do a little separate worksheet over here to do that. And let's figure out, well, we have the beginning debt before we consider our new debt. The beginning debt was equal to the $15,000. And then we had a rate on that beginning debt, which was the 10%. 10%, let's go ahead and make that a percent. Home tab, number group, percentifying it. Let's underline it too while I'm here. Home tab, font group, underline. I'm going to put then the interest on original debt to the far left now, or the far right, sorry, the right, left. And then this is going to be the 15,000 times 10%. So that was our original interest. And then we have the new debt that we're going to be taking on. New debt is going to be equal to the 8,000 we're going to be taking out here. 8,000 of new debt. The rate on it is going to be that 13%, which is gone up. And so that's not good. But that's going to be the home tab, numbers, percentifying it, and then home tab, font, and underlining it. That's going to give us our interest on the new debt. We'll put that in the outer column, which is going to be the 8,000 times the 13%, and that'll give us our total interest. Outer column is going to be equal to the sum of the prior debt interest and the current interest, and that'll be our total. Let's put an underline over here, home tab, font group, and underline. There's our interest. I'm going to put that in our financial statement now. So I'm going to say this will be equal to the 2,540. It, of course, has going up. That's going to bring the earnings after taxes down. So we're going to have the earnings before interest and taxes minus the interest earnings before taxes has now decreased. Home tab, font group, underline. Taxes then are going to be lower now because we have less things to be taxed on. So at least we're giving less to the IRS. So we're going to say that's going to be the 35% of our earnings before taxes, and then home tab, font group, and underline. And then we're going to say this is the 460 minus the 161. That's going to give us the 299. And then we're going to be considering the number of shares that we have outstanding. Now, we took that 8,000 that we had from the bonds and we purchased back the shares costing, we're saying that they're going to cost $10. That's what it has on our price down here. So the $10 actually is being equal to the par value. Don't let that throw you off. So the $10 is going to be their market price and the par value. That means we're going to be purchasing back with our $8,000, 800 shares. So we're going to buy back then 800 shares. We had before 1,500 shares minus the 800 we're going to buy back. That means we're going to have 700 shares. So now we have a less earnings after taxes, but we also are distributing them amongst less shares. Not necessarily shareholders, because one person can hold multiple shares, but there's less units of shares out there. So we're going to be taking then the 299 divided by the 700, adding decimals, home tab, numbers group, add a few decimals, and we could keep going. I'm going to stop at 2 like we usually do. And then, so now we have, it's decreasing the earnings per share here with the debt plan. So even though we have less shares that are outstanding, we had a decrease in the earnings after taxes as a result of the fact generally that we had a pretty high rate, which is higher than the prior rate that we had here. So this is actually decreasing the earnings per share. This plan decreasing the earnings per share as we stand in our original standpoint. Then let's say that we have that the equity plan. Equity plan means we're going to issue stocks 800 at the $10, getting that 8,000, and then we're going to pay off the debt. So in this case, we're going to issue more stocks and pay off the debt. What would happen then? Well, okay, we're going to say let's calculate the interest. I can do a little calculation for the interest over here for the equity plan. We're going to have the beginning debt was this 15, and then we're going to pay off part of it. Pay off. And how much are we going to pay off? Whatever we're going to get from the stock issuance. We're going to issue more stock to get money, which is going to be that 800 times the 10. So we're going to be getting $8,000, and we'll subtract that out. So the 15 was our original debt minus the 8,000. We currently have 7,000. That's our new balance on the debt. Let's put an underline on the 8,000. Home tab font group underline. That then will multiply by the rate. That rate being the 10%. This is going to be equal to the 10% still that was on the original debt. Let's go to the home tab number group, make that a percent, and home tab font group underline. That means that the interest is going to be equal to the 7,000 times the 10%, or the $700. So now we're going to say interest is going down to 700 under the equity financing plan. Let's put an underline here, home tab font group underline. Subtracting this out, this is going to be the 3,000 minus the 700, giving us the 2,300. Taxes then equal to that 2,300 times, we're saying the tax rate now being 35%. Subtracting this out, we got the 2,300 minus the 805. Let's put an underline in the 805, home tab font group and underline. So now you can see what's happening with the earnings. Of course, the earnings are higher because we have less interest due to the financing being through equity as opposed to through the debt, but we're going to have a lot more shares. We're going to have a lot more shares to allocate over as we issued more shares, more equity interest in the company. So what is the number of shares that we have outstanding? Well, we just issued then another 800 shares out there. So before we had the 1,500 equity interest plus the 800 shares we issued, that's going to give us the 2,300. So the prior balance and the earnings after taxes divided by the number of shares now, adding some decimals, home tab, font numbers group, adding a few decimals. We could keep going. We're going to stop at 2. And note we're at the same point that we started at here. And that's because basically the debt rate that we had is equal to the return on assets before interest and taxes. So the equity financing, we ended up basically at the end point. We have a higher income here because we paid off the debt, but we're allocating that money to more shareholders because we had to get the funding by issuing equity interest, which, I mean, you could think about the results of issuing more stock, more owners in the company, or more potential owners, more shares out there, and that gives us the same basically earnings per share, whereas the debt ended up with a lower net income because, of course, of the interest that was a result of the issuing of the debt. But then you would think, well, that would counter out possibly if we paid off or bought back our own stock, because now we have less stock out there that we have to allocate the earnings to. But we in this case ended up with a lower debt, and that's basically because the interest rate on the debt, you can see here the interest rate is pretty high on the debt. So we ended up with a lesser scenario there. So that's where we're going to stop here, and then we'll do some adjustments in the next presentation, just taking this scenario and then making some adjustments, such as we're going to calculate the earnings per share if the return on assets before interest and taxes was now 13%. So basically increasing then our top line number and then running these scenarios and see what would happen. And then we'll take a scenario where we have back to our 10% that we started with, but now we're going to say the interest rate on the new debt is only 8% as opposed to the original, or what we had in the original problem, which was a pretty high 13%. So we'll take a look at those two scenarios and consider what will happen on the earnings per share from them.